Welcome, everyone, to today's episode of Dollars with Sense. Two financial gurus, Ela Lange and Terence are here to give you enlightenment in the world of finances. Today's topic is an in-depth look at what an ETF, or exchange-traded funds, are, and how it works with its pros and cons.
That's right. Hello, everyone, and welcome again to another information-packed episode here on Dollars with Sense. Before we delve into the world of ETFs, we would like to invite you to connect with us. You may have questions or comments or stories to share that would be beneficial for our other listeners. Feel free to reach out to us by email at twofinancialgurus@gmail.com. That's the number 2financialgurus@gmail.com, and we will answer your questions. Take it away, Ella.
Okay, so an exchange-traded fund, ETF, is a type of fund, obviously, that owns assets like bonds, stocks, gold bars, etc., and divides ownership of itself into shares that are held by shareholders. The details of the structure, such as a corporation or trust, will vary by country, and even within one country, there may be multiple possible structures. So the shareholders indirectly own the assets of the fund, and they will typically get an annual report. Shareholders are entitled to a share of the profits, such as interest or dividends, and they may get a residual value in case the fund is liquidated. Their investments in the fund can easily be bought and sold.
ETFs are similar in many ways to traditional mutual funds, except that shares in an ETF can be bought and sold throughout the day, like stocks on a stock exchange through a broker-dealer. Unlike traditional mutual funds, ETFs do not sell or redeem their individual shares at net asset value. Instead, financial institutions purchase and redeem ETF shares directly from the ETF, but only in large blocks, such as 50,000 shares, called creation units.
Purchases and redemptions of the creation units generally are in kind, with the institutional investors, such as Investors Group, contributing or receiving a basket of securities of the same type and proportion held by the ETF. Although some ETFs may require or permit a purchasing or redeeming shareholder to substitute cash for some or all of the securities in the basket of assets.
It's a little bit complicated. The ability to purchase and redeem creation units give ETF a method intended to minimize the potential deviation between the market price and the net asset value of the ETF share. Existing ETFs have transparent portfolios, so institutional investors will know exactly what portfolio assets they must put together if they wish to purchase a creation unit, and these transactions affect the updated dollar value of the shares throughout the trading day, typically at 15-second intervals.
Whoa, that's fast. If there is a strong investor demand for an ETF, its share price will temporarily rise above its net asset value per share, giving arbitrageurs, those looking for a buying opportunity, an incentive to purchase additional creation units from the ETF and sell the component ETF shares in the open market. The additional supply of ETF shares reduces the market price per share, generally eliminating the premium over the net asset value. A similar process applies when there's a weak demand for an ETF. Its shares trade at a discount from the net asset value.
In other words, folks, it's complicated, but ETFs generally provide the easy diversification, low expense ratios, and tax efficiency of index funds, while still maintaining all the features of ordinary stock, such as being able to do limit orders, short selling, and options, and these are all strategies called market timing. Because ETFs can be economically acquired, held, and disposed of, some investors invest in ETF shares as long-term investments for asset allocation purposes, while other investors trade ETF shares frequently to implement, again, market timing investment strategies.
Among the advantages of ETFs are the following. They've got lower costs. So ETFs generally have lower costs than other investment products because most ETFs are not actively managed and because ETFs are insulated from costs of having to buy and sell securities to accommodate shareholder purchases and redemptions. ETFs typically have lower marketing, distribution, and accounting expenses. Buying and selling is much more flexible with ETFs. They can be bought and sold at current market prices at any time during the trading day, unlike mutual funds and unit investment trusts, which can only be traded at the end of the trading day. As publicly traded securities, their shares can be purchased on margin and sold short, enabling the use of hedging strategies, and traded using stop orders and limit orders, which allow investors to specify the price points at which they are willing to trade.
The tax efficiency of ETFs generally generate relatively low capital gains because they typically have low turnover of their portfolio securities. While this is an advantage they share with other index funds, their tax efficiency is further enhanced because they do not have to sell securities to meet investors' redemptions. Also, market exposure and diversification. ETFs provide an economical way to rebalance portfolio allocations and to equitize cash by investing it quickly. An index ETF inherently provides diversification across the entire index. ETFs offer exposure to a diverse variety of markets, including broad-based indices, broad-based international and country-specific, industry sector-specific, bonds, and commodities. Transparency with ETFs, whether index funds or actively managed, have transparent portfolios and are priced at frequent intervals throughout the trading day, as we said before.
So, the main reason for the buzz around ETFs is that they have a reputation for lower costs than traditional mutual funds. This will be evident as a lower expense ratio. This is mainly from two factors: the fact that most ETFs are index funds and some advantage of the ETF structure. However, this needs to be compared in each case, since some index mutual funds also have a very low expense ratio and some ETF expense ratios are relatively high. An index fund is much simpler to run since it does not require some security selection and can be largely done by a computer.
Not only does an ETF have lower shareholder-related expenses because it does not have to invest cash contributions or fund cash redemptions, an ETF does not have to maintain a cash reserve for redemptions and saves on brokerage expenses. Mutual funds can charge 1 to 3% or more. Index fund expense ratios are generally lower, while ETFs are almost always less than 1%. Over the long term, these cost differences can compound into a noticeable difference.
Because ETFs trade on an exchange, each transaction is generally subject to a brokerage commission. Commissions depend on the brokerage and which plan is chosen by the customer. For example, a typical flat fee schedule from an online brokerage firm in the United States, for example, ranges from $10 to $20, but it can be as low as $0 with discount brokers. Due to this commission cost, the amount invested has a great bearing. So someone who wishes to invest $100 per day or per month, may have a significant percentage of their investment destroyed immediately, while for someone making a $200,000 investment, the commission cost may be negligible. Generally, mutual funds obtained directly from a fund company itself do not charge a brokerage fee. Therefore, when a low or no cost transactions are available, that's when ETFs become very competitive.
The cost difference is more evident when compared with mutual funds that charge a front-end or back-end load, as ETFs do not have loads at all. The redemption fee and the short-term trading fees are examples of other fees associated with mutual funds that do not exist with ETFs. Traders should be cautious if they plan to trade inverse and leveraged ETFs for a short period of time. Those close attention should be paid to transaction costs and daily performance rates, as the potential combined compound loss can sometimes go unrecognized and erase potential gains over a longer period of time.
You have to stay on top of it, basically.
Yes.
ETFs are structured for tax efficiency and can be more attractive than mutual funds. We see whenever a mutual fund realizes a capital gain that is not balanced by a realized loss, the mutual fund must distribute the capital gains to its shareholders. This can happen whenever the mutual fund sells portfolio securities, whether to reallocate its investments or to fund shareholder redemptions.
These gains are taxable to all shareholders, even those who reinvest the gains distributed in more shares of the fund. In contrast, ETFs are not redeemed by holders. Instead, holders simply sell their ETF shares on the stock market, as they would a stock, or effect a non-taxable redemption of a creation unit for portfolio securities. So that investors generally only realize capital gains when they sell their own shares or when the ETF trades to reflect changes in the underlying index.
An interesting benefit of an ETF is the stock-like features offered. The mutual fund is bought or sold at the end of a day's trading, whereas ETFs can be traded whenever the market is open. Since ETFs trades on the market, investors can carry out the same type of trades that they can with a stock. For instance, investors that can use market timing techniques like selling short or using a limit order, using a stop loss order or buy on margin feature. One can invest as much or as little money as they wish, so there's no minimum investment required. And also many ETFs have the capability for options. They're called puts and calls to be written against them. Covered call strategies allow investors and traders to potentially increase their returns on their ETF purchases by collecting premiums. That's the proceeds of a call sale or right on calls written against them. Mutual funds do not offer those features.
Again, very complicated. New regulations were put in place following the 2010 flash crash, when prices of ETFs and other stocks and options became volatile, with trading markets spiking and bids falling as low as a penny a share in what the Commodity Futures Trading Commission, or the CFTC, investigation described as one of the most turbulent periods in the history of financial markets. These regulations proved to be inadequate to protect investors in the August 24th, 2015 flash crash, only happened a year ago, when the price of many ETFs appeared to come unhinged from their underlying value. ETFs were consequently put under even greater scrutiny by regulators and investors. Analysts at Morningstar claimed in December 2015 that ETFs are a digital age technology governed by a Depression-era legislation.
On the not so good side of things, here are the risks of ETFs. The ETF tracking error is the difference between the returns of the ETF and its reference index or asset. A non-zero tracking error therefore represents a failure to replicate the reference as stated in the ETF prospectus. The tracking error is computed based on the prevailing price of the ETF and its reference. It is different than the premium or discount, which is the difference between the ETF's net asset value, so it's updated only once a day, and its market price. Tracking errors are more significant when the ETF provider uses strategies other than full replication of the underlying index.
Some of the most liquid equity ETFs tend to have better tracking performance because the underlying is also sufficiently liquid, allowing for increased investment flexibility. In contrast, some ETFs, such as commodity ETFs and their leveraged ETFs, do not necessarily employ full replication, because the physical assets cannot be stored easily or used to create a leveraged exposure, or the reference asset or index is illiquid. Futures-based ETFs may also suffer from negative roll yields.
ETFs have a wide range of liquidity. So some funds are constantly traded, with tens of millions of shares per day changing hands, while others trade only once in a while, even not traded for some days. There are many funds that do not trade very often. This just means that most trading is conducted in the most popular funds. The most active funds are very liquid, with high volume and tight spreads. In these cases, the investor is almost sure to get a reasonable price, even in difficult conditions. While other funds, it is worthwhile to take some care in execution. This does not mean that less popular funds are not a quality investment, however. So this is in contrast with traditional mutual funds, where everyone who trades on the same day gets the same price.
Some have argued that ETFs represent short-term speculation, that their trading expenses decrease returns to investors, and that most ETFs provide insufficient diversification. ETFs are dependent on the arbitrage mechanism in order for their share price to track net asset value, or the NAV. While the average difference between the daily closing price and the daily NAV of ETFs that track domestics is generally less than 2%, the deviations may be more significant for ETFs that track certain foreign indices. The Wall Street Journal reported in November 2008, during a period of market turbulence, that some lightly traded ETFs frequently had deviations of 5% or more, exceeding 10% in a handful of cases. The trades with the greatest deviation tended to be made immediately after the market opened.
According to a study on ETF returns in 2009 by Morgan Stanley, ETFs missed in 2009 their targets by an average of 1.25% points, a gap more than twice as wide as the 0.52% point average that they posted in 2008. Part of this so-called tracking error is attributed to the proliferation of ETFs targeting exotic investments or areas where trading is less frequent, such as emerging market stocks, future contract-based commodity indices, and junk bonds. The tax advantage of ETFs are of no relevance for investors using tax-deferred accounts, or indeed investors who are tax-exempt in the first place. In a survey of investment professionals, the most frequently cited disadvantage of ETFs was the unknown, untested indices used by many ETFs, followed by the overwhelming number of choices.
As we've said, it's complicated. Some critics claim that ETFs can be, and have been, used to manipulate market prices, including having been used for short selling that has been asserted by some observers to have contributed to the market collapse of 2008. According to a recent Bloomberg article, the recent surprise election result caused the average investor to sell their ETFs to the tune of $3.9 billion. Now, the larger institutions are buying these funds at the lowest prices of the year.
There you go. Well, I would say that's a pretty good in-depth view of ETFs. So what is your takeaway or action item for this week? I believe that what has been demonstrated again is that the draw of low fees can be deceiving. To keep on top of these details and rely on market timing is a losing game for the average investor. Growing your wealth on your own has so many pitfalls, distractions, and confusing possibilities. It's no wonder that the average do-it-yourself investor ends up with poor returns.
And how can we say that? Well, take a look at the graph that's coming up on your screen right now, and you can see that this is the asset class returns versus the average investor, quote unquote, for the years of 1993 to 2013. And at the very right-hand side of the graph, you'll see the red bar, and that is the average investor's return, which is approximately 2.3% per year from 1993 to 2013. Your action item for today is really simple. Answer yourself this question. Do you want to spend the time and energy to teach yourself enough about the market to end up making 2.3% over the long term, the average investor's return, as we pointed out, from 1993 to 2013? Or are you interested in having a great financial planner to take care of this and all your financial planning needs while still achieving a reasonable long-term rate of return of 7+%? With mutual funds instead of self-directed ETFs, yes, the fees will be more, but that is because you are getting a professional to take care of it all for you.
If you choose the latter of the answers, the next step is to find a great financial planner, and that's where Terence and I, your two financial gurus, come in. Reach out to us. We can make sure your financial future is on the right path to achieve your goals. You can call us at 778-879-0820. You know you guys can email us at twofinancialgurus@gmail.com. That's the number 2financialgurus. Leave us comments on our Facebook page. That's called Dollars with Sense, so it's easy to find. And you can also listen to our 36 other episodes on smart financial planning. Finally, you can also go to our YouTube channel by typing Ela and Terence in the YouTube search bar and subscribe so that you get a notification every time we add a new episode, and you can listen to all our previous episodes.
Thanks, everyone, for tuning in today and taking the first step in getting control of your financial future. We hope that you have a productive week, and we look forward to having you back with us here on Dollars with Sense. Until then, this is Ela and Terence, your two financial gurus, wishing you all the best. And may your dollars and cents be with you.